If you start studying business, you'll see very soon that the focus of finance isn't just on revenue or how much money your gym is bringing in, but on profit or how much money your gym is keeping. The only problem is that profit is a proxy. It's not actually how much you're keeping, it's a tax treatment. Today, we're going to talk about a better way to track owner benefit over time so that you're clear on how you're doing as the owner of the business. My name is Mark Fisher from businessforunicorns.com, and if you want a totally free, totally awesome, and helpful assessment, you want to click the link in the description box below and go to gymownerreportcard.com. When you're there, you can download an awesome free assessment tool that will allow you to quickly identify what is the next thing you need to work on to move the ball of your business forward to your preferred future. As the saying goes, revenue is vanity, profit is sanity, and cash is king. I think the first part is pretty intuitive, of course, because revenue isn't what you keep, it's just how much money's coming in. But I want to unpack the second part of it a little bit. Now, the first thing I want to note briefly is classically, when we're saying cash is king, we're referring to cash flow. So we're adapting this for our purposes, right? To say that the gym's revenue is vanity, the profit on your P&L is sanity, but the actual cash that the owner is keeping, including perks and benefits and distributions, is king. So that doesn't roll off the tongue. While profit is saying, here's what I want you to understand. In a vacuum, if I tell you that Gym A has a profit of $10,000 on $30,000 of revenue, that is 33% margin, it's $10,000 of profit. If I tell you that Gym B is making $5,000 of profit on $50,000 in revenue, well, you might say, okay, well, that's $5,000 revenue per month. That's only 10% margin. Well, Gym A is doing 33% margin and twice the profit, but with less revenue. We might hypothesize that the Gym A is a vastly superior business to Gym B. Well, maybe. It's really a question of what you're optimizing for, because the profit on your profit and loss is not necessarily the most important number in the business. For instance, in the above example, Gym A, which is making $10,000 of profit on $30,000 of revenue at a 33% profit margin, doesn't technically pay the owner anything. So none of the owner's compensation is showing up as an expense. Out of the $10,000 of profit that comes in, the owner takes $5,000, and that is how they're being paid. So they're making $5,000 of total owner compensation on the $30,000 of total revenue, which is 16.66%. Gym B, on the other hand, is making $5K in profit with $50K in revenue. But the owner is taking $15K per month in payroll and perks. Now that's showing up as an expense, so it's hurting the profit margin. But when you do the math, that's 30% in total owner compensation. So in absolute dollars, it's 3 times as much compensation and almost double of the percentage of the revenue coming in going to the owner. So your takeaway here is that profit just isn't really the end all be all. Certainly not when we're talking about profit that lives on the P&L, which I'll say yet again, is a tax treatment. And in fact, I'm gonna be real with you here, right? So I follow most people that talk about fitness businesses, and honestly, I'm not always clear what they're even meaning when they talk about profit, because you hear people sometimes speak about profit margins or benchmarks, and I'm always wondering, are they including the owner pay in the margins? I think not. And when they say profit, is there any kind of expectation that there's going to be a draw? Some of it might be retained earnings, maybe just gonna stay in the business and build up an emergency slush fund, or potentially it's saved up and then reinvested. And I share this certainly not as a criticism of anybody, just to sort of get hyper specific about, well, what is it we're actually talking about here? Now, I also want to clarify, I am not saying that profit on the P&L doesn't matter. It definitely matters. And Lord knows, if you are optimizing for profit because you're looking to get a loan, buy a building, buy a mortgage, overall, it's still a pretty good proxy for the business. I mean, listen, if you've got really fat, huge margins, in most situations, while the absolute dollars matter too, you're probably doing okay. And conversely, even if you're being paid very well as an expense, I still like to see the profit at least 10%, because I want the business to have some margin for error if and when either an unexpected bill comes in and or there's an unexpected random dip in revenue. Because while I guess you could say that you're willing to just skip payroll if you need a given month, if you have a bad month from an unexpected bill comes in, I prefer you to not skip payroll, and I prefer you to keep paying your cell phone bill. So I think the best way to do this is just to track your total owner compensation on a monthly and yearly basis. And total owner compensation is a pretty simple concept, right? It's just like, what is your payroll? What are your perks? And what are your owner draw? And the way that I recommend people do this is I actually encourage them to track their take home, their net pay from payroll, the perks that they're getting, whether it be like cell phone, maybe it's paying for a car, etc. And then the net take home of the owner distributions. Now, the tricky thing is your distributions, depending on the type of business entity you are not gonna show up on a P&L. So you might wanna just have a separate spreadsheet where you just track per month, what was the revenue, what was the net take home from your payroll, what is the total amount of perks. And by the way, in places like Xero, or depending on your online bookkeeping platform, you can pretty easily set it up so it can automatically tabulate and do that math for you. And then finally, it's not gonna be on the P&L in most situations, but what owner distributions or draw, if any, did you take that month? And then you can add up those three numbers and very quickly see at a glance. Importantly, this is, I think the number this gets interesting is, what is the percentage of revenue that is recognized as total owner compensation? And since I know you're curious, I'll just say that generally speaking, if it's a smaller business that's ramping up and temporarily really investing in employees to grow the biz, or maybe it's a very big business and you're not having much to do it anymore and the absolute take home is pretty good, but the percentage is lower because other people run it for you, I like to see total owner compensation no less than 15 to 20%. And in a lot of situations, if you either are running a very lean business or you are actively working a lot in the business, really leveraging your time effectively, that can go up as high as 30, 50%. All right, friends, well, I hope you enjoyed this video. If you wanna find out more about how I actually track this stuff for myself, you wanna click the link in the description box below and check out my video about the exact numbers I track, both personally, financially, for myself, for my health habits, and for the business. And in closing, if you haven't subscribed to this channel yet, go ahead, hit that subscribe button. And if you're interested in finding out more about what we do with gym owners to help them achieve more income, more impact, and more freedom, head over to businessforunicorns.com. I'll see you soon for another video where I will soon share with you actionable tips, psychological frameworks, and philosophy.